Hello traders, Gary Wagner here, approximately 3 o'clock in Honolulu, 8 o'clock in New York. It is Friday. Happy Aloha Friday, as we say on the islands, 12th day of March, 2021, and this is the daily report for gold and silver, our weekend review, and what a difference we've seen between last week's weekend review and this week's weekend review. Because if you recall, my topic was, is the glass half empty or half full? In other words, I felt we had such an exceedingly and overwhelmingly, and to a great extent, exaggerated bearish market sentiment that, as I said yesterday, it always seems darkest right before the dawn. We saw gold break below 1700, actually did that today, a low of 1796, and closed well above it at 1725. We also initiated long positions across the board in gold, silver, the ETFs, Forex, and spot. To that degree, on today's show, we will talk about our exit strategy, the target that we are looking at in terms of a place gold pricing could trade to. I hope you enjoy the show. Traders, even with dollar strength and higher yields in the Treasury 10-year notes, we did see gold close fractionally higher on the day. In terms of the April contract, it gained $3.20 and is currently fixed at $17.2580. Of course, we are long from approximately $17.22. We'll talk about our trade, of course, when we pull up our charts. When we look at GLD, that was also a recommendation of ours. You can see that it did sell lower during the day, but closed in essence unchanged at $161.49 per share. Market participants are 100% responsible for bidding gold pricing higher. As you can see, the dollar index did close higher, about 0.3%, currently at 91.695. I've just put up the Kitco Gold Index so you can see the breakdown in terms of spot gold and spot silver. When I look at today's activity through the eyes of a daily candlestick chart, what stands out most is the intraday low that gold achieved and how that corresponds to what I believe to be a critical level of new support. 1725.80, that is our close. When we look at our low, though, that came in at $1696.60. The other way to look at the potential bottom in gold is to determine the strength or lack of strength of trend. To do that, we are going to look at our Henkin Ashi candles. You can see that during a defined downtrend, you have an absence of these upper wicks for the most part and decent body size. As body size diminishes, you typically get to what's called your pivotal candle. That is this doji-like candle here. That was followed with two green candle days which had no lower wick. The same cannot be said for today. So while we could be witnessing a pivotal candle or a reversal candle, my sense in this particular case is we're simply witnessing some sort of consolidation. And that is the one thing that you can see in many occasions in this type of chart. When you begin to get sideways trading action, you get to get small-bodied candles with alternating colors. And traders, it is Elliott wave theory that has been instrumental in me looking at the potential for a bottom formation when coupled with Fibonacci retracement. We are looking at a daily candlestick chart in which we can clearly see that we had a B, C, which concluded on a fifth wave and a minor fifth wave. From there, we obviously went into a multi-month correction, taking us to these lows, and we will go ahead and pull up a Fibonacci retracement that simply looks at the area of 2088 to approximately 1680. Because what that allows us to do is to create a model or forecast where a rally could go to, assuming that we hit our bottom here and are now moving towards higher territory. While the models we create use standard protocol or formulas to determine our forecast, we find that if not exact, they can fall very close to the parameters that we've laid out. One of the most accepted techniques in predicting A, B, C type retracement is A is always going to be our benchmark. And then once we have this in place, meaning the range itself, we look for this counter wave to move anywhere between 50 and say 75% of the price decline that resulted from the corrective A wave. That being said, we could see gold, if in fact it does enter a solid rally mode, gain a substantial amount even on a counter wave that could take pricing between 1880 and call it 1990. If that is the case, we would have an exceptional move to the upside. We are positioned properly at approximately 1722. We have our stops in place. We will have to see how this market unfolds over the next 2 weeks in terms of key levels of support. We need to have this particular point at approximately 1680 to 1690. If not, all bets, of course, would be off. This has been Gary Wagner, wishing you, as always, good trading. We will talk to you tomorrow for the next daily update